Most people think that balancing a metals portfolio is about predicting prices, but it's not. It's about understanding your risk tolerance and letting price movement do the work for you. Good morning, it's today again. Welcome back to Joseph's Reserves. I'm Joseph, and I store 20% of my income in the form of rare coins and precious metals. Congratulations to Emmanuel for being the first comment on my last video. Thank you so much for the support, and y'all go find him down below in the comments to start a conversation. First off, let me be clear up front. I am not a financial advisor. Nothing in this video is financial advice. This is just how I think about balancing metals over time. Everyone's situation, goals, and tolerance for risk are different, so you should always do your own research. People often ask how to decide which metal to hold and in what proportions. The obvious answer seems like it should be price, but it's not. Balancing a metals portfolio is really about understanding risk tolerance, time horizons, and how markets behave. If you get those right, you don't need to be perfectly timing the market. You just need to have a framework that survives changes. When most people hear balance, they immediately start to think of fixed percentages, a specific number of ounces, or choose a ratio that never changes. But balance is not static. Metals are priced in dollars. Dollars move, prices change, but the coin doesn't change weight. Its dollar value does. So balance must be a relative concept, not just an absolute number. This is why we use percentages instead of ounces. A metal's percentage share of your total portfolio tells you how significant that metal is to your overall exposure. Price movement doesn't mean something's wrong, it means something's changed. In traditional financial planning, risk tolerance is often defined as the amount of loss an investor is comfortable with experience in exchange for potential gain. For example, when an advisor builds a stock or bond portfolio, they use questionnaires to assess how much volatility a person can emotionally and financially endure. These questionnaires ask questions like, how would you feel if your portfolio dropped 20%, 30%, or more? Would you sell at that point, hold, or buy more? How long can you wait before needing that money? And that is the same core idea here. But instead of stocks and bonds, we're talking about precious metals. Risk tolerance in a metals portfolio is more than just the price volatility. It's also about how long you can hold through swings, how easy it can be for you to access your metals if you need to, and how much emotional stress those swings can cause. If a drop in silver keeps you up at night, then your allocation to silver should reflect that discomfort, not just your belief in where you think silver should go. Let's talk about volatility first, because it's the easiest to feel even if it's the hardest to define. Silver, for example, historically moves faster with larger swings than gold, and that's part of why it attracts so much attention. Big moves feel exciting or scary, depending on the direction. Platinum can be even more volatile because its market is smaller and tied to different economic sectors. Gold, in contrast, tends to move slower and smoother. It doesn't surprise people often. Risk tolerance here is really emotional tolerance. How well can you sit through a drawdown without abandoning your plan? That's why, depending on your personality and experience with volatility, your allocation to these metals may or may not align with raw ounce representation. In modern finance, volatility is often quantified with statistics like standard deviation or betas, and while you might not need that math here, the concept is the same. If a metal regularly swings widely and you can't emotionally hold through that, your tolerance for that metal should be lower. Next up is time horizons. In financial planning, time horizon is absolutely critical. Everyone saving up for retirement in 30 years has a very different timeline than someone who might need those funds in 5 years, and that affects what kind of mix they hold. Metals are no different. A long time horizon gives you room for markets to gyrate. It lets time smooth out that volatility. On the other hand, if you know you might need liquidity in the near future, your priorities switch towards stability and liquidity. Silver might perform over long cycles, but it can undergo sharp corrections. Gold historically is steadier, and that doesn't mean that gold always wins. It simply means that gold tends to hold the purchasing power more consistently over time, especially through economic crisis. Your time horizon, or how long you can let the metal work for you, should influence how much you hold relative to more volatile metals. Another concept is liquidity. Liquidity is how easily you can turn a holding into usable purchasing power. In traditional investing, cash and highly traded stocks or bonds are considered liquid. In metals, liquidity becomes physical. Gold is widely recognized and easy to sell at scale. Silver is liquid too, but bulky. There's more metal to move around and different premium layers to consider. Platinum is liquid in certain financial markets, but physical platinum coins and rounds have a smaller buyer base. If you need value quickly, whether it's for emergencies, large expenses, opportunities, liquidity matters. Real metal is more liquid than many assets, but some metals are more liquid than others. Even within the metals, some products are more liquid than other products, and that is a risk that you need to weigh when allocating. In portfolio theory, concentration risk refers to having too much exposure to one asset or sector. If that one asset performs poorly, your entire portfolio suffers more. The same idea applies here. Let's say if silver spikes and now makes up a huge percentage of your stack, you have more silver exposure, not a diversified metals portfolio. Diversification doesn't guarantee gains or prevent losses, but it does limit how much a single outcome can determine your financial picture. That's why balance isn't static, it's dynamic. It responds to market behavior. This concentration risk is where trades or movements across metals come in. The idea is that if one metal, say silver, significantly outperforms gold, it would make sense to move some of that value from silver over into gold, the now undervalued metal. Since the number of ounces didn't change how much you're actually holding, only the value of what you're holding changed, it's easiest to think of this in percentages across your entire portfolio. Another risk we need to talk about is behavioral risk. This is the risk that is least talked about, but arguably the most impactful. Behavioral risk is the risk that you would abandon your own plan at exactly the worst time. Traditional investment theory recognizes that investors are often their own worst enemies, selling low in panics and buying high in euphoria. In precious metals, panic selling out of fear and regret can be just as damaging as trading based on hope. This is why having frameworks matters the most. Giving yourself a rule, a set condition that triggers a rebalancing, moves emotional impulses out of the equation. So what does rebalancing actually look like? Balancing is not a single target, it's not a magic number, it's an intentional response to a change. When a metal runs hard, its share of your portfolio grows. That's a signal, not just noise. If something grows beyond your predetermined range, that's when it becomes reasonable to consider rebalancing. Not because the markets tell you to do something, but because your own criteria says that it's now overweight relative to your tolerance. Rebalancing is not selling into cash. It's moving strength and momentum into metals that have become underweighted. It's a transfer of exposure from one area that has had a run into another area that has not. So it can help to have some images on how different risk tolerances might express themselves. And before I go on, I'm just going to say that these are examples, not prescriptions. Do not just blindly follow these based on what you think I say. Definitely do your own research on your own risk tolerance. But a conservative profile would be someone who needs stability and liquidity. They might tilt heavier towards gold because it tends to be less volatile and more widely recognized as a store of value. A moderate profile would be someone more comfortable with some volatility. They might hold a meaningful amount of silver with gold as an anchor and a measurable slice of platinum. A higher risk tolerant person would be someone with an extremely long horizon and a high volatility tolerance. They might lean towards silver and platinum, with gold still present as a stabilizer. But again, these are not rules, they're patterns of tolerances, they're not predictions of performance. Another huge aspect of how I choose to rebalance my portfolio in precious metals is through dollar cost averaging. Dollar cost averaging is often talked about as a way to avoid bad timing, but that's only part of what it does. Dollar cost averaging really gives you consistency. It removes the pressure to guess and keeps you participating regardless of what the market is doing. When prices are falling, dollar cost averaging will automatically buy you more ounces with the same amount of money, and when prices are rising, it buys fewer ounces. But those ounces you already own are now worth more in dollar terms. That alone smooths out volatility over time. But here's the part that doesn't get talked about enough. Dollar cost averaging also creates conditions that make rebalancing possible. I like to think of it this way. Dollar cost averaging builds the stack, and rebalancing shapes it. Dollar cost averaging is always on. It's mechanical. It doesn't care about headlines, sentiment, or whether something feels expensive or cheap. It just adds exposure over time. Rebalancing, on the other hand, is occasional. It happens when big price movements cause one metal to drift outside the level of the risk tolerance that you are comfortable holding. That means dollar cost averaging is what grows the portfolio, while rebalancing is what prevents that growth from becoming lopsided. One of the biggest mistakes people make is thinking that they need to constantly rebalance, and they don't, especially if they're dollar cost averaging. When a metal becomes underweighted because it's lagging, the dollar cost average can be sent to have more buying power in that direction. You can buy more ounces in the metal that's fallen behind without ever selling anything. In that sense, dollar cost averaging acts as a soft rebalancing. It nudges the portfolio back towards balance gradually without forcing a trade. This is important because a forced rebalancing too often introduces friction, premiums, spreads, taxes, and sometimes regret. Dollar cost averaging avoids that by letting time and consistency do most of the work. Rebalancing only becomes necessary when your dollar cost average is no longer enough, when one metal runs so far, so fast, that it overwhelms the portfolio. At that point, the issue isn't price, it's exposure. If a metal's percentage grows beyond the range that you're comfortable with holding, you're no longer diversified, you're concentrated. And that's when rebalancing becomes risk management decisions, not a market call. And importantly, this isn't about selling because something went up. It's about acknowledging that success in one area increases the risk elsewhere. And this is where some people can get confused. Rebalancing is often mistaken for market timing, but they're not the same thing. Market timing is trying to predict what will happen next. Rebalancing is responding to what has already happened. You're not saying this metal is going to fall, you're saying this metal now represents more risk than I intended. And that distinction matters a lot more than you might think. One is speculation, while the other is discipline. So overall, balancing a metals portfolio is not about beating the market, it's about staying aligned with your risk tolerance, your time horizon, your liquidity needs, and your personal emotional capacity. If you have a framework that survives volatility, and if you can stick to it, you build clarity, discipline, conviction without relying on guesswork. If you're interested to see how this thinking applies to real numbers in my own stack, not as advice but just as an example, this is something I explore further with my members who are building alongside me. So go ahead and check out my community page and my membership perks. And you can now write me at Joseph's Reserves, 10160 Highway 242, Suite 800, number 401 in Conroe, Texas, zip code 77385. Make sure to include your information so I can write you back. If you like this video, make sure to give it a thumbs up. Go down into the comment section or on my community page to start a conversation. And please subscribe and share the video. But most of all, thank you so much for watching. And just remember, every ounce adds up, so no matter how small, just keep stacking. That's all for today, but if you'd like to stick around and see what other pretty coins I pull out, stay tuned. If you made it all the way to the end of this video, let me know by commenting your favorite coin that I showed.